Welcome back. Today we're diving deep into Cheniere Energy. Now this is a really fascinating company that basically engineered itself for stability in one of the most volatile markets on the planet. But the big question we're asking is, can that stability actually last?
And there's a very good reason we're talking about them right now. I mean, just look at this number. So far in 2026, the stock has absolutely skyrocketed, jumping over 50% and hitting all-time highs. A move like that, well, it makes you sit up and pay attention.
So this brings us to the core question, right? What on earth is fueling this kind of momentum? Is this a genuinely new era for the company? Or is the market just getting way ahead of itself? To figure that out, we have to start with the basics, how Cheniere actually makes money.
Okay, so to really get Cheniere, you first have to understand their business model. And honestly, it's pretty brilliant. It's powerful, it's surprisingly simple, and it creates a ton of stability in a sector that's, well, not known for being stable.
The secret sauce, the entire foundation of the company, is built on these things called take-or-pay contracts. Now, you can think of it like a subscription service for energy infrastructure. Customers sign up for decades, we're talking 20-plus years, and they pay a fixed fee, guaranteeing Cheniere a steady income stream whether they actually use the service or not. It's incredible.
So really, Cheniere's whole model is basically a toll road for natural gas. They get the gas, they charge a fixed toll or fee to liquefy it, and then it gets shipped off. This super simple process almost completely insulates them from the wild price swings you see in the energy markets, turning their business into a remarkably predictable cash machine.
And that business model, that cash machine, is exactly why investors are so bullish right now. So let's break down the bull case, the argument that this incredible run might just be getting started.
First off, their financial performance in 2025 was, to put it mildly, stellar. I mean, the company didn't just meet expectations, they absolutely blew them out of the water. They shipped a record number of LNG cargoes, and check this out, net income surged an incredible 64% from the year before. Second, they're rewarding shareholders in a massive way. The company just announced a new plan to buy back over $10 billion of their own stock through 2030. You know, when a company does that, it's a huge vote of confidence for management in their own future.
And where does that confidence come from? It all goes back to that business model we just talked about. When over 95% of your capacity is already locked in with long-term contracts, your CEO can go out and say something like this. It just perfectly illustrates the power of that toll road model.
So when you put it all together, the argument for being a bull is pretty darn compelling. You've got amazing financials, a huge commitment to giving cash back to shareholders, and a very clear roadmap for growth as their new projects come online.
Okay, but let's be realistic. After a 52% run-up in just a few months, you have to ask the tough question, is all this amazing news already baked into the stock price? So now let's flip the coin and look at the bear case. What clouds might be gathering on the horizon? The single biggest risk, not just for Cheniere, but for the entire industry, is a potential supply glut. See, 2024 was pretty quiet in terms of new supply, but 2025 through 2027, that's a completely different story. We're talking about a massive wave, a tsunami of new capacity, over 100 million tons per year, that's about to hit the global market.
And who's leading that charge? The 800-pound gorilla in the room, Qatar Energy. As the world's lowest-cost producer, their gigantic Northfield expansion is designed to do one thing and one thing only, crank up the price competition across the globe. This is Cheniere's #1 rival, no question.
And some people are definitely taking notice. Short interest, which is just a fancy way of saying bets placed against the stock, jumped by 24% in March. Now that's not a panic signal, but it is a clear sign that a growing number of traders are starting to think this stock is due for a fall.
So the bear case really comes down to these big external pressures. The valuation looks stretched, a global flood of supply could hurt prices, competition is heating up thanks to players like Qatar, and the geopolitical situation that's been so favorable could always change on a dime.
So there you have it. You've got this really powerful bull case, all about execution and that amazing business model, and then you have the bear case, focused on valuation and this coming wave of competition. So what should you be watching for as we go through the rest of the year?
The most important thing to watch, by far, is the completion of their Corpus Christi Stage 3 project. Throughout 2026, you're going to want to listen for announcements that their new liquefaction facilities, they call them trains, have reached what's known as substantial completion. Every time one of those trains comes online, it's like a new cash register starts ringing for the company. When you strip everything else away,
The entire story for Cheniere in 2026 boils down to this one single tension. Has this company evolved into a stable, almost utility-like business that deserves its high price tag? Or is it just a classic energy company hitting its peak right before a giant wave of competition crashes ashore?
And that brings us to the final, multi-billion-dollar question. Will that toll road business model, that incredible contractual moat they've built, be strong enough to defend against the coming flood of global LNG? How the market answers that question? Well, that's going to write the next chapter for this American energy giant.